Hey everyone, welcome back. Go ahead and put your financial analyst hats on today because we are diving deep into an explainer on Serve Robotics. Now, this isn't just a look at some cool, futuristic tech. We're going to rigorously evaluate their market viability, dissect their unit economics, and map out their actual path to profitability. We're tracking a really fascinating shift in local commerce here, where a company is trying to turn the massive hype of artificial intelligence into tangible, recurring revenue, right on our city sidewalks.
All right, here's our analytical agenda for today. 1. The macro thesis. 2. Serve's DaaS revenue model. 3. Dissecting unit economics. 4. Q3 financials and liquidity. 5. The 2026 growth targets. And 6. Risk factors and final verdict. Okay, let's dive into this.
Section 1. The macro thesis. Framing the $200 billion last-mile opportunity.
So think about this. We're looking at a global delivery market that is heading toward a $200 billion opportunity by 2030. But for years, the industry has relied on a fundamentally broken model for short trips. I mean, using 2-ton gas-powered cars to deliver 2-pound burritos, it creates traffic, pumps out emissions, and literally destroys merchant margins. Well, Serve Robotics completely flips this script. Their AI-powered robots produce zero emissions and are hyper-optimized for a 0 to 2-mile urban radius. For these specific sub-2-mile trips, Serve targets up to a 50% cost reduction compared to legacy human courier models. That cost delta, that's the entire foundation of their business case.
And they've moved with a velocity that is honestly incredibly rare in hardware startups to capitalize on this. Originating as a robotics project within Postmates, Serve was actually spun off as an independent company following Uber's acquisition in 2021. They then secured the capital they needed for scale with a $40 million NASDAQ public offering in 2024. And by the end of 2025, they hit their massive target of deploying 2,000 robots across major U.S. markets. With that, they officially became the largest sidewalk delivery fleet in the country.
Section 2. Serve's DaaS revenue model. Dissecting the revenue mix.
Now, what's really interesting about this slide is the shift from hardware hype to real monetization. It's one thing to build a cool robot, right? It's another entirely to build a profitable business. Notice that Serve isn't trying to sell robots directly to consumers. They are selling delivery completion. They operate on a delivery as a service, or DaaS model. This means they charge per delivery fees or sign monthly enterprise subscriptions with massive partners like Uber Eats, DoorDash, and Shake Shack. Ultimately, this gives Serve a highly predictable, recurring revenue engine.
When we break down their 2025 top-line revenue mix, we see DaaS transaction fees make up the lion's share at about 70%. But look closely at the remaining slices. 15% actually comes from screen-as-a-service advertising and data licensing, basically turning these robots into hyperlocal mobile billboards. Another 10% comes from high-margin SaaS API licensing of their navigation stack to third parties, with the final 5% from other sources. This diversified mix is absolutely vital for an analyst to note because those high-margin software and advertising revenues lift overall gross margins, which rapidly shortens the payback period on that initial hardware capital expenditure.
Section 3. Dissecting unit economics. The AI to margin bridge.
So does this high-tech business model actually sustain itself at a municipal scale? To answer that, we track their operational loop. First, a merchant like 7-Eleven or an Uber Eats partner loads the order. Second, the robot navigates using advanced AI-driven routing powered by NVIDIA's Orin Edge platform, seamlessly handling super complex pedestrian environments. Third, and absolutely most importantly for our financial modeling, is high asset utilization. Because they target highly dense urban corridors, these robots can execute 10 to 15 deliveries every single day. And this brilliantly illustrates the path to profitability. High utilization, driven by cutting-edge NVIDIA processing, directly dilutes the fixed cost of the hardware over a much higher volume of paid transactions.
But, none of those economics work if the robot constantly gets lost or stuck. Across over 100,000 autonomous deliveries, Serve boasts a stunning 99.8% delivery completion rate. For merchants and enterprise platforms, operational reliability is the absolute prerequisite for adoption. Simply put, you cannot replace a human courier if the robot fails to actually deliver the food.
Section 4. Q3 financials and liquidity. The earnings call breakdown.
Let's look at the hard numbers to see if the commercial traction actually matches the technological promise. The year-over-year growth here is explosive. Q3 2025 revenue hit $687,000, which is a 209% increase from the previous year. Daily supply hours, meaning the actual time robots are actively ready to accept offers, skyrocketed by 713% to nearly 3,800 hours. And total delivery volume grew an incredible 300% compared to Q3 2024. This isn't just a fun pilot program anymore. These metrics firmly validate the commercial traction of their dense urban deployment strategy.
Now, building hardware is notoriously capital-intensive, which is exactly why their balance sheet is just as important as their income statement. At the end of Q3 2025, Serve reported a highly defensive liquidity position of $210 million, which was further bolstered by a subsequent $100 million equity offering. This proves beyond a doubt that they have the financial runway and the capital efficiency required to fund future fleet expansion without hitting an immediate cash wall.
Section 5. The 2026 Growth Targets. Accelerating to Scale.
With a rock-solid balance sheet and proven unit economics, management's forward-looking projections are aggressively turning heads on Wall Street. So the crucial point is this. Based on current indications, Serve's management is projecting roughly a 10x increase in revenue for 2026. A 10 times multiplier in a single fiscal year? That is a massive target. It indicates they believe they've successfully moved past the R&D and pilot phases and have firmly entered the replication and scale phase of their business cycle.
So how exactly do they intend to deliver on a 10x revenue multiple? Well, they have several specific growth levers to pull. First, a new multi-year strategic partnership to roll out deliveries across the U.S. with DoorDash, which expands their volume potential immensely. Second, maximizing the pure revenue capacity of the 2,000 robots they just deployed. Third, targeted geographic expansion slated for Europe and Asia by late 2026. And finally, integrating recent tech acquisitions like Value for AI foundation models and Phantom Auto for ultra-low latency teleoperation. These integrations are expected to heavily drive down data infrastructure costs and further improve those operational margins.
Section 6. Risk Factors and Final Verdict. The Bull versus Bear Case. No equity research explainer is complete without impartially weighing the risks against the strategic mitigates. On the bear side, investors definitely must watch for regulatory caps or municipal licensing fees that could suddenly throttle those unit economics we talked about. There's also the constant threat of rapid AI obsolescence and, of course, the physical risks of operating hardware in public spaces, like vandalism and theft. On the bull side, however, Serve has built a formidable manufacturing moat through their partnership with Magna International, severely driving down unit costs. They also have an unrivaled distribution channel directly integrated with both Uber Eats and DoorDash. Plus, their robust IP portfolio covering Level 4 socially intelligent autonomy creates a very high barrier to entry for smaller, boutique rivals. Let's move to and see how this builds into the broader philosophy of the company. Serve's CEO, Dr. Ali Kashani, recently summed it up stating, "The difference between delivering value versus hype in AI comes down to real-world application." And that perfectly brings us to our final takeaway. The unit economics are proving out, the liquidity is completely secured, and the deployment targets have been hit on time and on budget. But the ultimate question remains for focused learners tracking the space. Will Serve Robotics simply remain a successful but niche player in last-mile food delivery? Or will their AI-powered fleet evolve into the core logistics infrastructure for smart cities worldwide? The $200 billion delivery market is waiting for the answer. Thanks so much for joining this explainer, and keep your eyes on the sidewalks.